Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson and Tom Mackenzie. With the cash trade just less than an hour away, here's what you need to know. France's finance minister warns the country could face a debt crisis if Marine Le Pen wins the upcoming snap parliamentary election. After 2 days of volatility, we bring you the open of European bond trade. US stocks power to another record, but a rally in Treasuries takes a pause as investors brace for a double whammy of US inflation data and a Fed rate decision. Plus, gilt demand hits a record high as expectations dim for Bank of England monetary tightening, while Prime Minister Rishi Sunak promises more tax cuts in the Tory election manifesto.
OK, let's check in on these markets then. European futures pointing to a modest turnaround after the losses, of course, so far this week. So much of that pinned to the political risk out of France. European futures pointing to gains of 0.4%. The FTSE 100 is looking to add 35 points. Commodities getting a bit of a lift. We'll see if there's a read-through there for the UK. The US 10-year, 4.39, a successful auction, 10-year notes yesterday, 10-year treasuries, I should say, around 39 billion. Of course, dependent on the inflation print later today and that FOMC decision with the dot plots in focus. Euro dollar at 107. Markets today starts right now.
Wednesday, the 12th of June. Good morning, folks. We have three big volatility events that we are going to be managing for you throughout the day. It is going to be an interesting ride, I suspect. Many people would argue that the main event is the Federal Reserve. 2 p.m. Eastern, 2:30, the press conference from Jay Powell. Before that, of course, at 8:30 Eastern, we get the CPI data. Those two factors are likely to interact with each other. A weak print on CPI affects the Fed. A strong print affects the Fed. But before all of that, I do wonder whether the main volatility of the event of the day is going to be a press conference coming out of Paris a little bit later on, 11 a.m. local time, with the French president, Emmanuel Macron. What is he going to say after calling that snap poll and the chaos that has followed in financial markets? It's going to be a busy day. Let's start with France.
Yeah, absolutely. The line that stands out to me, a debt crisis, this from Bruno Le Maire, a debt crisis is possible in France. A Liz Truss scenario is possible, and this certainly catches the eye.
That was the line that really stood out, wasn't it? We could be facing our Liz Truss moment in France. Bruno Le Maire, it's quite remarkable how frank he's being about the debt crisis risks, and I guess part of the rationale is to try and scare voters into voting for them and the party, of course, of Macron versus the party of Marine Le Pen. But there is a risk to that risk scenario that he's outlining.
There's a risk to that strategy, perhaps, in terms of what markets do with that information in the interim. One other risk that we're going to have to watch is alignment amongst the parties. Interesting, the one centre-right Republican yesterday suggesting that party could align with Marine Le Pen. It was quickly shouted down.
That was the leader of the Republican Party.
Called on to resign by colleagues. But it just underscores the volatility, the uncertainty.
And you've also got this grouping on the left, which is kind of changing the arithmetic around what is happening with the polling as well, really quite significantly. It does seem as if maybe we are going to see maybe some unexpected outcomes here. And the polling certainly is struggling, really, I think, to get a handle on what is happening here. The markets are also struggling to find a way through this, trying to understand the implications of it. You are seeing significant spread widening. OATs, OATs versus bunts. That's the core spread you want to watch at the centre of Europe, but it's impacting the periphery as well. What do we know? What are we going to find out a little bit later on? Let's set the day up for you. Caroline Conan joins us now from Paris. There is much speculation about this press conference coming up a little bit later on, Caroline. Talk to us about what the polls are telling us and what the expectation now is for this Emmanuel Macron press conference that I think it's, 11 a.m. Paris time?
That's right, in a few hours from now. And in fact, there was a little panic also in the middle of the day yesterday on the French bond market when there was a rumor that Macron, the president, would put his job in the balance if he doesn't win these legislative elections at the end of the month, something that was quickly denied by the Elysée. But you can imagine the anxiety at the moment on the markets and among the members of Macron's party, because, of course, all these people from this government have also their job on the line. You heard from the French finance minister, Bruno Le Maire, last night, who was talking about this Liz Truss scenario. I don't have to explain to you what a least stress scenario is, of course, but the economic program of the National Rally is very vague and is estimated to cost an extra 100 billion euros a year when you already have the deficit, which was more than 150 billion euros last year. And you remember a couple of weeks ago, France was already downgraded by Standard & Poor's. So you can imagine the anxiety, of course, on the French bonds market that could continue if we see the similar polls that we have seen over the past couple of days. The polls showing that the National Rally could get as much as 35% in the first round on June 30, and Macron's party would get about 18%. But of course, this is slightly different than the European elections because it is a two-round system. Usually, that puts the far right at a disadvantage, but a lot will depend on alliances. As you mentioned, Anna, yesterday you had the head of the Republican Party, Éric Ciotti, extending ahead to the National Rally. Now, a lot of people in his party are calling for Éric Ciotti to resign, saying this is not the line of the mainstream right. But Jordan Bardella, the head of the National Rally for this list, for these legislative elections, said last night that a few dozens Republican MPs could actually join the National Rally in this first round. And of course, that could be a game changer.
OK, Caroline Conan in Paris, thank you very much. Bloomberg's Caroline Conan with details there of what we are looking out to ahead to. And you mentioned the volatility we've seen in bond markets, Guy, and we're going to get back to this in, 25 minutes' time, roughly. The timing does change day after day, doesn't it? But OAT's underperforming over the last couple of days. But yesterday, as Caroline said, we saw real volatility as yields shot up on speculation that Emmanuel Macron himself might go, then came down as the people familiar with that situation said that wasn't the case. Then he himself came out later on to say, no, I'm not resigning. So trying to put a lid on that kind of speculation.
We need to kind of try and get a handle, I think, on what the market is worried about. And Caroline, I think, kind of laid it out there. It's about the idea that the Le Pen government, Baudet government, would spend more. This is less about the tail risk of a euro breakup, but I think the market can't exclude that completely. That has, in terms of the tail risk, risen in terms of the risk that it poses. But it's this fiscal story at the centre of the French government, which I think is interesting. And that's what S&P was flagging as well. And I think that's what the market is nervous about. And that's why you're seeing this spread widening between France and Germany in such a big way at the moment. And it's going to be interesting to see kind of how far that ultimately gets pushed.
And that'll be interesting. 7:30, we've got a guest coming up to talk about the French bond markets. And he draws limited parallels to 2017. And he talks about the volatility we saw in bond markets there. But at that time, to your point, Guy, it was about Brexit. It was about the concern that if we saw Le Pen win, then we'd end up with France leaving the Eurozone. That is a position that the National Rally has pulled away from.
Absolutely.
But there's still these concerns.
And as the chief economist, Europe economist for Swiss Re was talking to us in the show earlier, she said, look, this is a two or three-step process. It's a two-step process in terms of the vote, and then the question as to whether or not, if they win the National Front, whether you get a Maloney-type adjustment.
I thought that was brilliant. I thought it was really interesting what she said.
Yes.
Why would you want to be Truss when you can be Maloney?
Yes.
I thought it was a really interesting point that she was making. Why would you want to go down that road, particularly as Le Pen is looking at the next presidential election? She doesn't want us to blow up now. She wants to prove that they are capable of governing so that they can pitch forward to that next French presidential election.
Maybe mindful of one of the reasons why Macron might have called this in the first place was to try and trip the rival up, give them only 2 years to do this, expecting that they will make mistakes in those 2 years and then prevent them from taking on that presidency later on in 2027, I think it would have been. But certainly a lot going on there. A lot to talk about when it comes to France, a lot to talk about when it comes to the United States as well. I think there's only, 5.5 hours between the CPI data hitting and then us getting the Fed rate decision. The dot plots are going to be in focus and the impact of the CPI data on those dot plots.
Yeah, so the core CPI is expected to moderate from 3.6% to 3.5%. That's the core picture. Again, we were talking with the economists about the stickiness of services, inflation. And then what we've been hearing consistently from FOMC officials, if you carve out Jay Powell to some extent, is that they are not comfortable until they've seen a number of softer prints. So even if you get a moderation today, to what extent does that give you some relief if you're looking at it from that scenario? Again, but the other question is 3, 2, 1. To what extent is the equity market vulnerable to that, or on the bond market?
Well, in theory,
that's where the volatility.
So the bond market's priced 1, right?
Yeah.
So we've got 1 cut priced for the rest of this year. If the Fed comes out and says 2, is that dovish? Is something that maybe you need to think about in terms of the context of kind of where current pricing is. But I also think you need to look at kind of where the Fed now expects the data to go. Does it revise up what it thinks is going to happen within the labour markets? Is there a more positive picture there? Does it revise up where it thinks sort of growth potential is, where our star is? All of these kinds of factors. What is clear is that the hikes that they've delivered have not had the expected impact on the market. So maybe actually there's a kind of longer-term tweak that needs to happen here, I say, that could have kind of profound impacts, I think, not just this year, but next year, the year beyond, and the year beyond that.
Yes, and we'll get into a conversation shortly about how the dot plots are used then today to communicate what it is that the Fed wants to communicate to markets. Nice piece on the Bloomberg Terminal talking about how even, traders in Asia who might typically be asleep during some of this are going to be staying up
setting their alarms.
To 3 a.m.
I might be asleep.
Yeah, exactly.
I'm going to stay
we're not even in Asia. We don't even have to, we're not staying up quite that far. But this is one of the biggest days of the month in terms of data and set-piece events, and so everyone's going to be focused.
Yeah, and we've got that volatility chart as well that shows this potential pickup in VIX volatility to the highest level that we've seen year to date as well. Just a reminder of the uncertainty around all of this. The surveillance team, by the way, going to be bringing, of course, special coverage of the Fed's rate decision from 6:30 p.m. London time. I can guarantee Guy Johnson will not be asleep at that point. We also have a stellar lineup, of course, of guests reacting to the CPI data and Fed decision. Former St. Louis Fed President Jim Bullard, of course, Mohamed El-Erian, and Bank of America's head of US economics, Michael Gappen, joins us. Plus, do not miss exclusive conversations with the legendary short seller Jim Chanos.
We've got some UK data just breaking, just the monthly data for April, adding that to the GDP picture that we already knew about. And it's flat, basically, which is slightly better than anticipated. Economists had expected this to contract by 0.1%. It didn't. It's flat. This comes a day after we got that wage data that did move the pound a touch, but not really. And this data this morning doesn't seem to be moving the pound all that much.
No, industrial production's a little weaker as well, but again, that's a fairly lumpy series, so I don't think you're seeing very much there. Yeah, it seems as if we've maybe plateaued a little bit in terms of the data. There is this sort of deceleration, and there was expected to be a deceleration, certainly in the month-on-month data. But the overall picture still on a quarter-by-quarter basis is that the economy is growing at 0.7, slightly better. We are dealing with second, third, fourth decimal places here in terms of how the data is being managed.
And if I'm forced to linger on the subject, I mean, I'm drawn slightly to the construction output part of the GDP data.
Don't pretend you don't love construction, Hannah.
Tom has this firm belief that you are our concrete correspondent.
Guilty as charged. UK April construction output falling 3.3%. That was only supposed to drop 1.8. It's dropped 3.3. This is a sector that has been hanging on and waiting for a rate cut and thinking it might come, and it hasn't come, and it isn't coming now because of the election. So they're still waiting and waiting. You wonder what that's doing to expectations within that sector.
Yeah, manufacturing production as well, contracting 1.4%. It was expected to contract just 0.2%. So the unemployment data picked up, of course, in the UK. That was a bit of a surprise, but wages were still relatively sticky, probably uncomfortable for the Bank of England. But pricing has been pulled forward for the BOE. So we're adjusting. September, I think, is where the markets have it right now.
We seem to oscillate between August and September.
Does it matter ultimately?
Right, and we're going to talk to Kit Jukes, who I think is going for an August move. So we'll get to him shortly. He's going to be waiting in the wings for us. Here's what else we're watching for today. I say what else, a bit of a recap of some of the things we've just talked about. US CPI, worth saying it again. We get that data today. Worth saying again, we have a Fed rate decision today because this is a really important event-packed session ahead. The IEA oil report, that'll be interesting in the context of actually a bit of a recovery in oil prices. Guy, you were pointing this out yesterday. We're back over $82 on Brent, so 82.43, up another 0.6% this morning. The Macron press conference, that takes place 10 o'clock UK time, 11 o'clock over in Paris. That'll certainly be in focus. Stephen Carroll over in radio reminding me how long those sometimes go on. They can go on quite a long time, so there's an opportunity to say a lot of things. The markets will be listening. We'll also hear from a number of ECB speakers. We will focus in on those comments. Given the pushback we're seeing from the ECB towards markets around expectations that one rate cut is followed by another rate cut in quick succession.
Yeah, they all seem to be saying the same thing, apart from the French, again, which is that we want to see more data. We are waiting. We are watching. We are not convinced that we need to go sequentially June and July. So when does the next rate cut come from the ECB, I think, is a critical question. Talking of France, we're going to come back to that next. We're going to stay across the latest as the country faces this crucial summer that we are now building up to. Can I just flag that the Olympics are about to start as well in Paris? Just going to kind of throw that into the mix as well, just to add an extra little kind of area of potential volatility as well. The unions, I'm sure, are watching that very carefully. Anyway, French bond markets will be opening very shortly. We will get you the latest on that. Plus, US CPI, the FOMC. Anna's just been running you through that. We're going to preview both. Any questions? Please join in the debate today. It's kind of one of those days. We'd love to hear from you. IB plus BB TV Go is the function. We're looking forward to hearing from you. This is Bloomberg.
I don't expect much in this meeting tomorrow.
The market basically anticipates the Fed to stay.
Powell will try to push back on the market in regards to when the first cut is going to be.
Trying to guesstimate that first move by the Fed, it's been a losing game.
You're probably going to end up with two cuts in the dot plot.
We tried, we missed.
Maybe in September.
Others have tried, they've missed.
Or maybe in December.
The Fed's tried, it's missed.
Risks are skewed toward that one cut.
Or maybe one or two cuts.
This Fed positions itself to be extremely data dependent, and data has been mixed.
I don't think just because we had one cut that we're all of a sudden going to be all in on an easing cycle.
So it will be perfectly natural if Fed would want to postpone the decision of the rate cuts that market puts so much emphasis on towards later in the years.
Some of our guests talking about the CPI print a little bit later on, talking about what the Fed is going to be doing and how it's going to be reacting to that and all the other data that we have got. My takeaway from all of that, nobody knows. We keep kind of trying to figure out, get some certainty, what exactly the rate path is going to look like. We keep being confounded and being blown off course by the fact that the data remains stronger and stronger than anticipated. Let's try and get some clarity, though. If you're going to look for clarity, you turn to our next guest, Kit Jukes, Head of FX Strategy at SocGen. I'm really setting him up here this morning. Good morning. We're going to talk about France as well in just a moment. But let's start off with the United States. I don't know. I have no idea at the moment kind of whether we get two, whether we get one, what we get next year, what the dots are really going to tell us, whether the dots are going to be accurate, whether they're actually a realistic reflection of kind of ultimately where policy goes. How is the market setting up for this? What is your kind of sense of where we are going into this, given the ambiguity we have surrounding the US economy?
I think most people in the market are kind of listening to your guests, actually. The next move's a cut.
Yep.
Exactly when it happens depends entirely on the data. And so the market set itself up a little that way round. And so you would change the world pretty significantly if you started thinking again that the next move might be a hike, which 2 months ago, we were kind of, on the edge of our sort of sit a bit. And then if it was imminent, and there were going to be several and the economy was genuinely slowing in a big way, then that would change people's minds. Otherwise, we're in no man's land. The sort of the pace of the most fashionable CPI, so trend mean CPIs, if that isn't higher than 0.3, as in 0.30, then we're going to see sort of 3-month averages trending lower again. So we had this blip up at the beginning of the year with the stronger data that has spooked the entire market, and we're coming down again. So it looks as if the chances of the next Fed move being a hike are really small again.
Yep.
Right? And beyond that, you sit there and say, well, given that the rate of inflation 3-month-ish is too high, and given the labour market's too tight and wage growth's a bit too high, why would they hurry? I mean, so best guess next year, not this year, until something changes.
OK. Given that, are we going to see some volatility in foreign exchange? Doesn't sound like it. Are we going to get out of the range that the euro's been in, which is really small? Are we going to break out of some of the recent ranges we've seen in some of the other pairs as well? Is the catalyst for that going to come from the United States?
Again, the catalyst has to be weaker in the United States to really move. I mean, the dollar's really strong. The US economy's really exceptional. It's actually quite hard for us to price in. It's even more exceptional than I was. So you have to price in something, either something weaker in the United States, which we're not seeing, but and CPI is difficult to do that. It's some of the other data. So the labour market data sort of killed off that idea for another month. And or get shocks from elsewhere in the world that change things up a little bit.
I'm setting Anna up here.
Thank you very much. So, talking about the other side of the euro-dollar pair, we just heard comments from the Bank of France Governor Villeroy saying the next government needs to have clear fiscal strategy. Is this at the heart of at least some of the market's concern here? It's about the fiscal unknown if we get big change in the French Parliament.
I think the market is just unknown almost more than putting its finger on a specific piece of unknown. I mean, what we have in Europe relative to the United States is like, why did AI have to be in Silicon Valley, not in somewhere in Europe? Don't care where. You know, why is all of Europe sending money to support the dollar? So, you know, I was asked by a client in Sweden 2 weeks ago, you know, why do the big current account surplus economies, Norway, Sweden, have such weak currencies? I said, because what are you doing with your portfolio? I said, well, I'm overweight treasuries, I'm overweight US equities. You know, you have too few investment, too many savings, and they pay more for them.
Yes.
And so do things fiscally or otherwise to change that is what we want in Europe, writ large.
And sticking with the French story and its impact, I read one analyst saying that the euro has a target on its back as a result of what is happening in France. Now, France isn't the euro, so to what extent do you think that is true? How much weakness can we see, Kit?
I think not that much in terms of exactly that. This is an important political story at a European level, perhaps in terms of what it means, but the currency impact of it is. It's another reason for the euro not to break out higher. You know, euro-dollar was poking its nose through 109 in great excitement 10 days ago. And it's firmly back in its basket, and this event has put it back in its basket. You know, the bottom of that basket most recently, micro basket 106, bigger basket parity-ish. I don't, you know, we got to 95 with the biggest terms of trade crisis in any of our lives by a big margin. If we're not going to do something that catastrophic to the euro again anytime soon, then its next 20-figure move, it probably will be up, but it's not today.
Do you want to hide out on the pound?
The pound, it benefits. I mean, you know, this morning's GDP data, as I've seen them on a phone, don't look that bad. I mean, the monthly change was a little bit better. That's something. I don't think it goes that far. This is benefiting by default. This is an opportunity for holiday makers at this time of year to get a little bit more euros for their pound, without doubt, and I shall.
Glad to hear that, Kit.
Well, I want sunshine.
Yeah.
And so it does benefit a bit, but the economy is not. You know, it's growing very slowly, and there's not much that makes you think it's going to accelerate without someone doing something to change things.
Kit Jukes, he's going to be digging out the sun lotion, the sun cream ahead of his summer vacation and getting some value in the eurozone thanks to the relative strength of the pound. Even if the fundamentals here don't necessarily tell the full story on pound strength. Kit Jukes, head of FX strategy at SocGen. Thank you very much indeed. Plenty more coming up on France next. This is Bloomberg.
New Democracy did win the election with 28%, and that percentage is higher than the total tally of the second and the third parties. So we still remain the dominant political force in Greece. So one should take into consideration the fact that these elections took place a year after a double national election, so there was significant electoral fatigue. We actually had a significantly lower turnout than the rest of the European Union, at around 40%. But I'm sure there was also, some degree of discontent with issues such as the cost of living, which we need to address. We've been elected to implement an aggressive reform program for the remaining 3 years of our term. this is what we should do. We now have 3 years without any other elections, and we will be judged again on our performance in 2027. But I think we sort of went against a trend where incumbents in many other important European countries actually suffered heavy losses. We avoided that, and we're still the dominant political force in Greece.
Well, indeed, and we look to France, of course, for the reaction there. Marine Le Pen and the risks there, and the decision by the French president to call that surprise parliamentary vote, and of course the gains of the AfD in Germany as well. What do you make? What is your interpretation of the shift to some of those right-wing parties across the Eurozone, whether it's a protest vote or there is something more substantial going on here?
Well, first of all, if you look at the total numbers, the EPP, the main centre-right European party, actually increased its numbers of Euro MPs. And the main sort of coalition between the EPP, the Socialists and the Liberals that has essentially governed Europe over the past decades remains the dominant coalition in the European Parliament. So I would argue that the European centre held, maybe stronger than many people expected, and that this right-wing surge did actually take place in the two most important countries in Europe, but not across the entire continent. So I think there is maybe some degree of over-exaggeration about this right-wing shift of the European sort of continent as a whole. If you look at the numbers in the European Parliament, I think the important decisions will continue to be made by the three political families. And of course, nothing, I need to point out, nothing can happen without the EPP, which essentially has sort of a blocking minority now in the European Parliament. So I think all in all, the results were probably slightly better than many people expected, and I do think that there is a momentum to drive through important changes in Europe for the next 5 years.
That was the Greek Prime Minister speaking exclusively to Bloomberg, of course, on how his party is still the dominant force in Greece. Right-wing parties did perform relatively well. They got about 18% collectively in Greece, but New Democracy, his party, did come out on top, of course, in those European elections, slightly better than expected. And, of course, talking about the gains for the EPP overall as well. But we continue to focus, and we discussed this, of course, and I talked to Mitsokakis about the French reaction and particularly Macron's surprise decision. So we continue to focus on the fiscal challenges of France and particularly the bond market reaction.
Yeah, absolutely. I mean, the broader questions around the surge of the right, the extent to which we saw that surge of the right, he was putting important context around that, wasn't he? Mitsokakis saying, yes, you saw it in France, you saw it in some other parts of Europe, but maybe don't exaggerate his view, of course. Don't exaggerate where we haven't seen it. We certainly have seen it in France. It's taken its toll on the bond market. We've seen a sell-off in French bonds, and today we see just a little bit of stabilisation, but let's not overdo that either. So we are not moving too much on the 2-year. The 2-year is open, and we see 3.158% is the yield on the 2-year. So we do see that yield coming down just a touch. The 5-year is the same story. The 10-year yet to open. The 15-year, for what it's worth, also seeing yields coming down just a touch. A little pause for thought, perhaps, in what's been a volatile couple of days for OATs.
The 10s aren't open. Can you just get on with it, please? Can we get the 10s open, please, so we can figure out exactly what's happening here? Just coming back to Mitsokakis, I think it's fascinating that we're not talking about Greece here. We're talking about the core of Europe. And I think that is why maybe this is resonating even more in terms of the market story as well. We're not talking about Greece. We're not talking about Italy. We're not talking about Spain. We're talking about France and to a certain extent Germany as well. I know the crisis is different in Germany and is yet to fully emerge, but the challenge that was posed in these European elections to the ruling government in that coalition in Germany, I think, is hugely significant. But we are talking about the core of Europe, and kind of where France sits in this as well, I think, is fascinating. Kind of, how do you judge France? How do you see France in this whole story about how Europe is going to go forward?
And the first level of uncertainty is exactly that, where we are on that transition, if that is what we are going to see, to something where the further right takes more control. But the other level of uncertainty that we talked about with Kit is what on earth that means for policy. What does that really mean for fiscal policy? What assumptions do you make about that? Let's talk to Théophile Legrand, who's a rate strategist at Natixis, brings us his thoughts on how the market is thinking about political risk from here. Théophile, very nice to have you with us. We've all looked at the polling. We've looked at what it says about National Rally. We're trying to work out whether, if we see more control going to National Rally, what will that mean for fiscal policy? And that's what the bond market seems to be wrestling with. What assumptions are you making, Théophile, on that front?
Yes, so briefly, that started on Monday with a widening of OAT bond 10-year spread. So there was a spike yesterday on the rumor of potential macro resignation in case of Le Pen victory. Now the market seems to be stabilizing around 60 BPs. So we see some equilibrium around 60 BPs for now. But the market will, of course, react on the press conference by Macron. And we have also some external factor such as a Fed, hawkishness of the Fed will impact also the risk appetite. It could have some impact on the spread.
Yes, and just to reiterate, yes, we have come into around 60 basis points on that spread. So yesterday, I think we closed at 62. This is France over Germany. Now we're back down to 60 as the 10-year French OAT has opened, and we see those yields coming down just a touch after 2 days of moving higher. You draw our attention to what we learned from 2017, Théophile, in your notes. And that was a time when we were talking about Frexit. Now, Le Pen and National Rally, they have a different approach to the Eurozone now. They're not talking about Frexit anymore. So how should we look back at 2017 and what we thought we knew about the party then and what it means for now?
Yes, so for the remainder in 2017, so the market was starting to price a Frexit with a redomination risk, and the spread widened to 80 BPs. And this redomination risk was explained and this political risk explained 40 BPs of the spread. Now the situation is a bit different because the market is more looking at the fiscal policy, the economic policy of the Europe, and the potential increase in the debt to GDP due to the future fiscal policy ahead regarding the program of the Rassemblement National.
OK, so about 40 basis points of that 80 basis points back in 2017 was part of the political risk. How much is part of the political risk now? And what is the level that you might be looking at, Théophile, in terms of when OATs start to look attractive at these levels?
Yeah, so now the stress level of the political risk counts for the half of 2017. So it looks like 20-25 basis points now, the political risk in the spreads. So that's why we think that the stress has to be less powerful than in 17. We expect now a stabilization in the spread. Can you repeat the second
stabilisation partly,
question, please?
Yeah, no, is part of that stabilisation going to come from French banks? Is your expectation that French banks, domestic banks, will start buying at these levels?
Yeah. So feedback from clients and especially from asset managers saying that at 70, 80 BPs, we can start to have some deep buyer on the spread. So that's why we think that the situation has to stabilize a bit.
Théophile, what would the Bund OAT spread look like if Le Pen's party were to win? How wide could it go?
So, of course, will depend on some factors such as European economic policy. So it depends on the situation if Le Pen wants to price a Frexit, but that's not the main scenario that we have today. The main issue will be, and the main uncertainty remain about the fiscal policy. I mean, so the extra cost of the Rassemblement National in 2022 was around 100 billion euros. So that's give a risk to a least trust moment. Or on the other side, we can have some Meloni also outcome with lower spreads. But on this other side, the Meloni party was a bit received some advice from technical and especially Draghi, and that's not the case today for the Rassemblement National.
In terms, is France core? If we were to see Le Pen winning, can I put France no longer at the core of Europe? And if so, how does that change the way that I want to think about bond portfolios in Europe and how people are going to hold the various national European government debts in their portfolios? How big a shift could this be in terms of the way we think about bond portfolios in Europe? Do I put France with Italy and Spain? And I know those economies are performing relatively well right now. But what is core Europe still? What is safe debt in Europe with no credit risk? Is it just Germany? Is it the Netherlands? Is it kind of what else do I put in that bucket? And is France still in that bucket?
We look at the studies that we made previously, and we saw that before Spain was a bit received some spillover effects from a widening of OAT bond spread, but that's not the case today. So Spain is likely to continue to outperform versus France. Also, we have some overperformance in EU, and of course, we have some long position from DSL or Austria against France, and that's quite a nice protection.
Can I ask you, Théophile, does this make a difference? What we're seeing in France, does it make a difference to ECB thinking right now?
I think the ECB, it's not, ECB of course is looking at the situations, but now the ECB is on track to fight the inflation. And of course, for now, we don't see an impact on inflation again, and we don't have enough fragmentation to study and to see an impact or an intervention by the ECB. So the situation is too early. We don't have enough volatility. Maybe something that ECB will look at if we have a strong widening in BTP bond 10-year spread. We can think about something about PPP intervention. I mean, activate the reinvestment in the PPP portfolio, but that's not the best case for now.
The fact that we're even talking about it, I find amazing. Théophile, thank you very much indeed. Théophile Legrand, rate strategist, joining us from Natixis. It's fascinating. Talking about the fact that Meloni had Draghi and the advice that was given, really interesting. That doesn't exist maybe here.
It doesn't, but also worth pointing out that advice from Draghi, the presence of Meloni, who he was contrasting there with Truss, favourably in terms of the market's viewpoint, that didn't prevent spreads from widening in Italy. You know, they have widened on the back of this, not as much as France, obviously. But we have seen a bit of widening. To your point about, you know, where do we put France? Which bucket is it in? It seems to be the south of Europe is moving with this French story.
It is, and Germany's moving in a different direction. And it's interesting that exists, but that maybe edges France towards that group rather than towards Germany, which I think is interesting as well. Anyway, what are we going to talk about next? We need to get back to some of the corporate news as well. Did you see Oracle last night? Really strong numbers coming through. That pivot to the cloud certainly seems to be paying off quite significantly. Big post-market move. Is that going to read across this morning into SAP? We'll talk about the single stock story next. This is Bloomberg.
Welcome back to Markets Today. 13 minutes until the start of cash equities trading for this, where are we, Wednesday morning. The futures picture looks a little stronger this morning, up around 0.4% on European stock futures. That outpaces Europe just a touch. US futures flat to positive. We're waiting for some big set-piece events, waiting for the biggest day of the month, perhaps, in terms of the US data and the US monetary policy story, at least. Let's talk about markets in 2 minutes, and we'll focus on the US. Bloomberg's Rachel Evans joins us, and she can talk us through the market story right now. Rachel, let's start with the bond markets. At a pivotal moment, waiting for CPI, and then just hours later, 5.5 hours later, I think we get the Fed's rate decision and all of the guidance that the dot plot there will provide. What are you looking at?
Yeah, it's going to be a wild ride, I think, today. There's certainly a lot of opportunity for volatility. Yeah, as you say, it is a pivotal moment for the bond market. Time after time this year, we have begun a rally. We've been picking up steam, and then some data point or the Fed has come along and sort of squashed that rally in its tracks. So the bond market now is really very neutrally positioned, and people had been building up some more long positions a couple of weeks ago. Those have now been kind of taken off the table. So we're kind of coming into this this really big day, looking for direction, one way or another. Are we going to see yields rising back towards those kind of cycle highs from last year of around the 5% mark, or are we going to finally see this rally transpire? I think that's really what kind of investors are going to be looking to today, and the dot plot for that is going to be crucial. We obviously know that the Fed was predicting 3 cuts for the year. That is clearly not going to happen. So the question then is, do they move to 2 cuts, or do they move actually to 1 or even no cuts for the year?
OK, so certainly that'll be something we are watching. Dollar strength then continues to be in focus as well. The greenback nearing the highest point this year. Clearly that's been very much to do with US outperformance and the rate path and assumptions around the rate path over in the United States. We've got some European politics to talk about too, but let's stick with the US story. What are we expecting on the dollar?
Yeah, so I mean, the dollar has been benefiting very much from the opposite side of that, this idea that we are going to see higher for longer rates. So I think what is going to be very interesting there is just kind of whether we can see that push beyond the year-to-date highs. We're kind of heading out to that level. We've seen positioning being very, very strong kind of coming into this, people really piling into bets on the dollar. So I'm looking to see kind of like whether we can see that because really push through the year-to-date high, because that's been a bit of a barrier for them so far.
And in terms of how many dots then, what is expectation? I think the economists are divided, aren't they?
That's split, yeah, between kind of 2 dots, or whether we actually see things kind of pull back towards 1 dot.
OK, which would mean 1 or 2 cuts this year. Rachel, thank you very much. Bloomberg's Rachel Evans on the markets.
Let's carry on with the conversation. Actually, before I let you go, Rachel, we're all in the volatility business. So some volatility sounds fantastic. So I'm just ultimately wondering where that comes from. Is it the Fed today, or is it France? A lot of people are comparing what is happening with in France to what happened in the UK with the Liz Truss moment. The Liz Truss moment had global implications. We saw Treasuries reacting to what was happening here in the UK, which was all a bit of a surprise to us, but it seemed to happen. Does France have the same potential to have that kind of global effect, or is this localised to the French borders?
I think yesterday was a very good example of how this can sort of spread over from those borders. We did see sort of Italian Bund spread widening out, kind of in sympathy with the French Bund spread as well. French bonds yesterday had, I think, their biggest 2-day move since 2020 at one point. So, I mean, we are seeing kind of like those ripple effects kind of definitely moving through to Europe, where obviously there are similar dynamics when it comes to same sort of central bank, same kind of easing regime that they are all dealing with. But whether it can actually spread to the US, I think that would require it to create a bigger risk aversion moment. And at the moment, like, the monetary policy situation in the US is just so key that that's really where people are focused.
OK, Emily's Rachel Evans, thank you very much indeed. With the setup, of course, ahead of the inflation data out of the FOMC decision, of course, and the market reaction to the fiscal volatility, or at least the fiscal uncertainty emanating out of France now on the back of the politics. Let's switch focus now. Get your stocks to watch with Joe Easton from our equities team. Joe.
Morning, Tom. So we're keeping an eye on software stocks today following a blowout quarter from Oracle in the US yesterday. That stock jumped 9.5% in the after hours as they reported better than expected bookings, with one number up around 40% in terms of their quarterly sales. Now, a lot of this has been driven by their efforts in AI, and here's the take from Barclays. They say that growth comments for fiscal 2025 should convince more investors that Oracle could be another winner, and in our view, not many investors were positioned correctly for this number. Now, the question is, will we see a read across into some of the other companies here in Europe that are exposed to companies like Oracle and the broader AI and software sector? Now, we have already seen a bit of a gain on SAP on the Tradegate exchange in Germany, so that one could be one that might see a bit of a boost. The other ones to look at are Sage, Dassault Systems and Capgemini in France, the usual ones we tend to look at in this space. Keep an eye on software today. Then over in Italian energy, we've got a bit of a share sell. Eni is offloading a big chunk of its stake in Saipem. This is the company that does oil engineering. They're selling a 10% stake in the drilling firm. That deal is worth €393 million, and we got a price. It is priced at €1.97, so at a small discount to where we closed yesterday, so potentially a negative. This comes as Eni reorganises to fund its transition into renewables and cleaner energy, so that's why they're doing that. But here we see the Saipem share move recently. They did have a strong report back in February, so potentially a good time to get out of some of that stock. There's the analysts on the screen. We've got buys at 17, not a single sell, decent numbers. Then what don't we want to talk about more than rat catching on breakfast television? Because we got Rentokil. We got news from the UK pest control company that an activist investor is buying a big stake in this company. We don't actually know the exact size, but it will be a top 10 shareholder. This is Peltz, which owns the Trian Fund. Now, Nelson Peltz does disclose that they have a stake, but they haven't said exactly how much. They have had talks with Rentokil. The big thing here is it's trading at a massive discount to its US rival Rollins, and that is where they might potentially look to try and boost that valuation. Keep an eye on Rentokil this morning.
Yeah, massive difference in valuation. Certainly our colleagues pointing that out in some of the stories overnight. Thank you very much for that. Our equities reporter, Joe Easton, will certainly put that story in a wider lens later on in the programme and talk a little bit what about this means for capital markets, London-based capital markets. It is Fed Day, it is CPI Day, both of them happening at the same time in the United States, or at least on the same day, 5.5 hours apart. We have futures in Europe pointing a little higher this morning as we wait for those big set-piece events. All focus, though, in the interim will be on Paris. We'll get the European equity open shortly. This is Bloomberg.
Good morning. Couple of minutes to go. Big Wednesday. Big Wednesday coming up. We've got major events. We've got a French press conference. Emmanuel Macron is going to be talking at 11 o'clock Paris time. 2 p.m. Eastern, we get the Fed decision. 2:30, we get the press conference. That's all coming up a little bit later on. We are waiting to see exactly how the French equity market opens this morning. That was the big event over the first couple of days of this week. We've already seen the bond market open. A little bit of green on the screen. Bid back, yields a little bit lower. Is that going to be replicated? How are French banks going to be performing today? Lots of things to talk about.
Yeah, French banks certainly under pressure yesterday. We were down more than 2% on the sector as a whole, and the biggest weights there were SocGen. They were some of the Italian banks as well, to the point that Rachel was making about contagion a little earlier in the programme. But BNP Paribas, various French banks and Crédit Agricole certainly under pressure yesterday, along with real estate stocks as well.
And some of the utilities, yep.
Yeah, so certainly a focus on whether that bounces back. In fact, all sectors across Europe were in negative territory yesterday. Uncertainty around the future for the French president, even though that was quashed during the session to some degree, that was certainly one of the dominant fears in the market.
And it's almost a uniquely challenging election to get a grasp on, given the different rounds that have come through and the potential horse trading around the second round. And then what kind of makeup any potential national rally team could look like. And, of course, that remains hypothetical. Real estate also took a hit, of course, yesterday. We look at the commodity space. There's getting a bit of a lift. Oil continues to push out modest gains. Inventories in the US shrinking on the back, at least most recent reports suggesting that inventories in the US are starting to shrinken, so that's giving a bit more of a lift to oil. There's the political risk as well, the geopolitical risk, as conversations continue around a potential ceasefire. But WTI, copper, iron ore also getting a lift in the session, so we look at the basic resources space as well, particularly here in the UK. We are 7 seconds away from the open, and of course on a day when maybe some investors will sit on the sidelines for more clarity on that data.
OK, here we go. Volatility day. The volatility day begins. It's already begun. The bond market's already been open. But for equities, it begins. We are watching French assets very, very carefully. I suspect it may take, once again, a few moments for the French market to fully open. But in terms of some of the early indications on the downside and on the upside, and I'm going to talk about kind of weightings here, you are seeing SAP rising on the back of what we saw yesterday from Oracle. That's an interesting trade. ASML is the biggest points gainer. Some of the drug stocks are in the mix, but the oil stocks also are bouncing higher. To Anna's point, everything seemed to be lower yesterday from a sector point of view. Today, a little bit more green on the screen.
A little bit more green on the screen, and that oil story is interesting. The oil price is rising this morning, up 0.6% on Brent, 82.38. An industry report pointing to lower US stockpiles was part of the reason for that. We're waiting for the IEA's outlook. That report is due a little bit later on, and that can move markets as well.
On the French banking space then, currently Crédit Agricole getting a bit of a lift in terms of the early part of this session. So
I think I saw a Jefferies upgrade.
Close to 2%. There was a Jefferies upgrade. Maybe that was part of it as well. And at what point does it look like a buy the dip scenario, given the sell-off that we've seen in French banks, if you have that confidence? So Credit Agricole getting a bit of a lift. Siemens Energy up 1.7%, one of the gainers as well. Moller Maersk, the shipping, of course, story remains pretty fascinating around the Red Sea, and freight rates 1.5% for Moller Maersk. Lloyd's here in the London as well, getting a bit of a lift, up 1.5%. On the downside, though, you're seeing some losses for the house builders here in the UK, and this is something I know is firmly in the wheelhouse of Anna Edwards. But Travis Perkins and Balfour Beatty taking a bit of a hit, down around 1.3, 1.4%.
OK, waiting for an opening price on Rentokil as well. We talked about this with Joe Easton a little bit earlier on. He was taking us through this story. We've got an activist investor taking a stake of unknown size, but a top 10 shareholder now in this pest control business. I don't want to put anyone off their breakfast, which is always a risk when you talk about pest control at 8 in the morning UK. But certainly that is one stock that we will be watching to see how far it jumps. The ADRs were stronger. It has a substantial US business. So the thinking is this Nelson Peltz trying to persuade another business to go list in the United States?
As we see, by the way, in terms of that listing question, Raspberry Pi listing here in the UK getting a lift in terms of the stock. We'll check on the trading for Raspberry Pi as well, because that stock gained close to 40%, and the CEO talking to me about the fact that actually when it comes to the metrics in terms of the valuation story, he didn't see too much of a difference. He said he went to the US to check it out. New York Stock Exchange ultimately decided, of course, on London. We zoom out to the macro, of course, given the inflation data out of the US, but arguably, potentially, more importantly, they're both significant. The adjustments around the FOMC and the forecast, the dot plots, of course. This was a question that the team put to Citadel Securities, Michael DePass, yesterday. Here's what he had to say.
I think for tomorrow, the focus really will be on the FOMC, and in particular, what does the dot plot show for the number of expected cuts for the rest of this year? That number has obviously come down materially over the course of this year, and the market's split between, I think, somewhere between 1 and 2 cuts. So there'll be a little bit of a reaction, whatever the outcome.
And, of course, to be clear, there is an expectation that some members of the FOMC will not be making their decisions around the dot plots, the forecast, until after the inflation print, the CPI print. Let's bring in at this point then Norman Willeman, Group Chief Strategist at Union Bancaire Privee. Norman, good morning. Thanks for joining us. How resilient is this equity market to an adjustment lower in the dot plot?
Well, we think there's some probability the equity market will react to that. But I think that in all honesty, we're really just waiting to get into the next earnings season, which starts in July. And that's going to be the key driver as we move into the second half, because as was pointed out, the market has already adjusted its expectation to a lower number of cuts as we go into the second half of the year.
That's interesting. So you're even looking forward. You're looking ahead. You're kind of looking past this to the earnings story. Is that on the assumption that if they cut on slowing inflation, that's obviously good news? If they don't cut, they hold, it's because the economy is holding up, and that's also good news for corporate earnings. Is that a view you would align with?
Well, if they cut, we think that will be a tailwind. But what we do know already is the economy in the U.S., and we're seeing the same in Europe, bottomed late last year. It's led by tech, but what we're looking for in the second half is that to broaden out into the non-tech sectors. And we think that's going to be the key for markets here. And so, a quarter basis point, half basis point, a quarter percent or 0.5% cut in the second half. We don't think the difference of those two really makes a difference to what the earnings trajectory is in the back half of the year.
Norman, good morning. It's Guy. We have political volatility here in Europe. Does that make Europe less attractive as a destination for money at the moment? Do you think it makes the United States more attractive? Or do you think what is happening in November kind of balances the two out?
Yeah, look, the political volatility is interesting in Europe, but let's be honest. That's going to come in the back half in November in the U.S. as well. And we think the issue that was raised earlier, are we going to see a UK-style problem? We think that's an issue, but that's probably an issue for 2025 rather than 2024 from here. And so, again, yes, it's an issue. It'll bring some volatility. But that's going to be really pushed into next year when the governments, as they're formed, are going to be faced with very difficult fiscal choices.
So what do you do right now? What are you looking? It's amazing. You've got US equity markets at close to record highs. We are waiting, as you say, for the next earnings season. We're trying to factor in what monetary policy is going to do. Just kind of talk to me about the symmetry of risk. How hard is it going to be to keep this equity rally going? How much further is there still to come on both sides of the Atlantic?
Yeah, look, we think there's another leg to this equity rally. As I mentioned earlier, you're going to see a broadening of that earnings recovery in the U.S., and that will spread to Europe. We're already starting to see that happen now. And we think that's a narrative through year end. But alongside that, as you point out, you actually want to be symmetrical here, because as we get into year end, these risks are going to build, in particular in regards to this fiscal narrative that's playing out. And so we do want to start building some protection into portfolios. And so alongside that building of equity positions or maintaining of equity positions into this earnings rally, we're also starting to build positions in things like gold, inflation protected, to try and hedge against what we think is coming in 2025.
Norman, good morning. Do you have a particular view on UK stocks right now? We have an example this morning of a UK company possibly about to come under activist pressure to move its listing. We're not sure that's the strategy, but Nelson Peltz of Trian taking a stake in Rentokil, and he's previously taken stakes in businesses with big shares and bigger operations in the United States, and they have subsequently decided to go and list over there. Do you have any thoughts on UK capital markets at this point?
Yeah, look, we do think there's a lot of value in UK equities right now. And the good news is we're also seeing again, a cyclical bottoming taking place in both the domestic economy and obviously the global economy for the big names in the FTSE 100. So we think both are a tailwind to UK equities here. We've actually recently added to our positions in UK equities to capitalize on what we think is a cyclical recovery moving forward in the UK.
You make the point, you've made the point during this conversation about wanting to see the earnings season. That's where we started the conversation. And you think broadening of some of the things we're seeing in the tech space is key for you. Remind us, Norman, your view on valuations within the tech space, because actually it's easy to lose track as these share prices move so quickly, but also expectations around profitability move quite quickly. It's easy to lose track. Where are you on valuations in tech?
Yeah, look, we think that's one of the key stories here. A lot of people are worried because we're up near all-time highs on a lot of these names. They haven't pulled back that much. But let's remember, underneath that, earnings growth has been tremendous. So if you look at some of the legacy big tech names, they're growing earnings 20-25% so far this year. And what that means is underlying valuations are improving, even if the stocks aren't going anywhere and staying sticky near their highs. And we think that's a good opportunity from here in some of the big tech names as we go into the second half of the year.
Norman, you've talked about increasing your exposure to UK stocks, UK equities, the cyclical story playing out. Looping back to the French story then, would you buy the dip? Have you been buying the dip on French stocks, French banks, other parts of that equity space?
Banks have actually done very well in Europe because of what we've seen on the interest rate side. You have a lot of banks really printing money given the movement that we've seen in rates from here. We are constructive in Europe, but to be honest, we've been a bit more cautious in terms of playing the recovery in Europe. We like the high-quality earnings streams that we see in Switzerland from here, and we think that should continue as we see some of this political volatility moving through the summer.
Norman, we're going to leave it there. Thank you very much indeed. Norman Villemin, Group Chief Strategist, joining us at Union Bancaire Privee. Thank you very much indeed. Let's take a little look at how the core six are performing this morning. You do have an SAP story that is developing. That's obviously a read across from what we're seeing on the Oracle numbers, which were really quite strong yesterday, and the move to the cloud certainly seems to be benefiting there. But a more mixed picture, I would say, across Europe this morning. I think it's interesting that luxury stocks in France are actually where the losses maybe are coming through this morning. Other areas are bouncing back, but you are seeing some weakness coming through into the luxury space. Let's get some more details as to what we're watching with single stocks. Joe Easton has all the details.
We've actually got plenty of red on the screen in terms of your results-driven movers today. A big profit warning out of Umicore over in Belgium. Now, this is a company that makes chemicals that are used in batteries for electric vehicles, and they are downgrading their guidance, seeing weakness in that market. Pretty interesting for the auto sector. Stabilis as well, down 15% in Germany. This is a company kind of operates in the background, making hydraulic springs that go into cars and other machinery, that kind of thing, getting hit on another warning, down 15%. And in the UK today, DFS Furniture, once again, another warning from them. They've put out a lot of profit warnings over the past couple of years. I recently bought a sofa from them. They couldn't get it up the stairs, had to send it back. I don't think that's the reason, but the stock is down 9% today. Legal in general, this one, I'm scratching my head because they have actually announced they're increasing their share buyback plans for the next couple of years, but their stock is lower. Potentially investors wanted more out of that one. I'll have to dig deeper into the notes, but we're down 4% on legal and general this morning. Then in terms of your cloud read across, we mentioned it in stocks to watch earlier, and we are seeing a little bit of a gain. As Guy mentioned earlier, SAP up 0.9%, Sage and Dassault Systems getting a bit of a move higher. Not much action over in Capgemini in France, given the focus on that election over in that market at the moment. Then in terms of your deals, Rentokil, a massive jump in this stock on news that Nelson Peltz has bought a stake. We don't know how much he's bought, but we do know that he is an activist that tends to try and influence strategy of companies. There is a question mark over the valuation on that one compared to the rivals like Rollins in the US's pest control. We don't talk about enough about pest control on the show, but Rentokil up 16% at the moment. Saipem ticking lower, down 1%, as Eni offloads a big chunk of the shares in that one. They are the largest holder with around 30% of the stock, but they're selling down some of that today, and we're seeing some weakness coming down, given that was at a discount. We've got HSBC because they're also in the deals news. They're buying a bigger stake of their Chinese JV. It's a small deal for them, but that stock is in focus, so we keep an eye on that one. Then Raspberry Pi, it's the second day of trading. However, bear in mind, it doesn't start full trading until Friday. We're still in prelim trading. I was actually on a trading floor yesterday, and a couple of people were trying to buy it, and they weren't actually able to do the big size deals they want to. That will have to wait until the 14th, but it's another day of gains following a massive jump for that stock yesterday. We're up another 4%, the biggest UK IPO for some time. Finally, we've got one morning call in the banking space today. BBVA gets a downgrade. This is over at Exane at BNP Paribas. It's falling 0.9%. Exane doesn't like the details of their attempts to buy Sabadell over in Spain at the moment, and that is the big thing for that stock at the moment. Exane recommends selling, and that one is coming down almost 1% over in Madrid this morning.
Joe Easton from my equity team. I was speaking to the CEO of Raspberry Pi. You're saying there's an AI story there as well, which is interesting in terms of the demand. On your sofa, Joe, you got the Lazy Boy. You've already got the Lazy Boy. You're going for the L shape, one of those big L shapes. So that's the problem. Did you try taking the legs off? Because otherwise, I got an image of you reenacting that Friends scene, that famous Friends scene.
Pivot.
Up a bit, down a bit.
Pivot.
I was pivoting all the way up with the chaise long. The chaise long, that's the part I couldn't get around the corner, and I had to send it back.
There, Joe.
They sent me back a two-piece, so it worked out.
That's the challenge.
Okay.
All right, let's pivot from sofas to something else. Thanks, Joe. Equity team, of course, checking in on the movers today. And there's lots more coming up, team, on all things France. Checking in, of course, on the volatility. Checking on oats as well. Given the pretty dramatic moves we've seen in the sovereign debt of France over the last few days, there's a little bit of a recovery, as we've been noting, very, very modest. Currently, you're flat, unmoved on the 10-year at 3.22 in France.
So you did your own pivot there. Nice. From talking about Raspberry Pi and sofas into French
I'm learning from
bond
the best.
markets. So, yes, we're waiting for... This is day 3, isn't it, of intense OAT watch. Monday was volatile. Monday we saw yields higher, just, unashamedly higher on political risk. Tuesday we saw them shoot higher and then come back down again, and today we're flat, waiting for the next leg of the story. I wonder, though, does it come from Macron? Because he can talk a lot, but if the worry is, from a market perspective, is that if the uncertainty is actually what others do, maybe we need to wait to hear from Le Pen and co.
What are they going to tell us? The lesson learned, certainly from the Labour Party here in the UK, is say as little as humanly possible in terms of the details around exactly what the policy is going to look like, ruling out a lot of things, not ruling in a lot of things. So clarity is maybe in short supply at the moment. French banks are still down. You look at Agricole, you look at some of these other banks, Monday, Tuesday, Wednesday, yes, they've gapped higher this morning, but they are still sharply down on the week, 4, 5, 6%. In terms of some of the losses that we're still seeing here. So we've not filled the gap yet in terms of the losses we've seen kind of from the beginning of Monday trade, out of Friday into Monday, And I think that's going to be, as Anna says, I think we need some more clarity before maybe...
Well, Norman Villemin was saying, look, he likes overall European banks. He wasn't being drawn on French banks in particular. And he says part of that is the interest rate regime. Well, that's starting to adjust, obviously, at 3.75 now from the ECB. And then you combine that with the political risks around France. And does the appeal around French lenders start to fade? Or is this still a buying opportunity for companies that otherwise have been performing...
How many rate cuts are we going to see here in Europe? That is the other question as well. We still don't know. And if the Fed's hawkish today, how does that change the thinking surrounding what exactly the ECB can deliver here? I think also is another question. So there'll be a read across kind of which is going to augment the story that we're already seeing developing here in Europe as well.
Not the 13th Fed district, but certainly doesn't operate in a vacuum. So that seems to be the analysis that's often applied to that linkage across the Atlantic. I was noticing the auto and parts sector is considerably weaker than others this morning. I was about to put in a note to Craig Trudell asking what's happening there. But this has been a sector under pressure, of course, of late, but not entirely clear what today's driver is.
I can't remember if I saw a note first thing this morning. There is this idea that they are going to maybe pivot away from EVs and that we are going to see more ICE engines coming onto the market, more hybrid engines. But the sense seems to be that it's still not going to be enough to fill the gap, the problems that are being caused by the EV market.
We're waiting for the decision, of course, from the European Union as to whether or not they put tariffs in place. Part of it may be that Porsche Automobile Holdings is ex-div today, so that's down 5.8% well, because it's ex-div. So that may be a factor. One of your favourite car makers, Ferrari, is still posting very modest gains. But as you say, Anna, across the sector, down for the automakers.
Coming up on the programme, we'll get back to the French story as lawmakers from Macron's party openly question his decision to call the snap election. We'll discuss how the market is reacting to the possibility of a right-wing parliament. That conversation coming up next. This is Bloomberg. .20 here in London, 9:20 in Paris. This is Markets Today. We are 20 minutes into our European trading session, and you can see that the overall picture for European equity markets is broadly positive, up 0.4% on the Stoxx 600. The CAC 40 up by around 0.25%, which isn't so far off the pace. I guess underperforms a little versus the DAX and the FTSE 100 today. So let's check in on French assets. We've got the equity market story. We've also got the bond market story developing for a third day here. We've got, first for you, the French bond yield story. And after we saw yields climb on Monday, volatile yesterday, the story today is fairly subdued. The 2-year, we do see a little edge higher in the yield there, but not by much. We're pretty flat on those yields as we wait to hear from the French president a little bit later on today. And in terms of the banking story, we're focused on what is a slight tick up in the French banking stocks, but it's by no means erasing the losses that we've seen over the last couple of days. So from an equity market perspective, we're not recouping those losses of 2 days. We're just pausing for thought, perhaps, and bouncing a little at the margin. Let's talk about what lies ahead. And the big set-piece event is the French president. He's going to be speaking. Emmanuel Macron says his position won't be affected by the results of the snap election. His comments come after reports that he was considering resigning, which triggered a sell-off in French government bonds. Macron is set to hold a press conference at 10 a.m. UK time. That takes place in Paris, 11 a.m. local time. Let's get to Caroline Conan, who's joining us now from Paris once again. One of the big focuses for markets, and we've seen banks sell off as a result of this, real estate stocks under pressure, bond markets under pressure, yields higher, is that we don't know enough about what Jordan Bardella, who would become Prime Minister if the National Rally did well, if they got a majority in the National Assembly, we don't know enough about his policies and what that would do to the fiscal landscape. Talk us through the thinking there, Caroline.
And in fact, we just heard some concern also from the Bank of France governor, Villeroy-de-Galhau, who was saying whoever wins the majority quickly needs to clarify their fiscal position, their fiscal program. Of course, that would be in order to avoid a potential debt crisis, a potential least stress scenario for France after July 7. Now, who is Jordan Bardella? He's 28, very young. He's been groomed as the heir of Marine Le Pen. Actually, very popular on social media, 1.5 million followers on TikTok. But his economic program is very vague. We know from the 2022 presidential manifesto of Marine Le Pen a few parts of her economic program. I'll give you a few examples. For example, she wanted to lower the retirement age back to 62 or even 60 years old in some cases. That would cost at least 30 billion euros to public finances. She wanted to nationalize highways, which is why you've also seen some impact on some stocks like Vinci or Eiffage over the past couple of days. She wanted some tax incentives to hire younger workers and to increase salaries in some cases by as much as 10% for some employees, and also some zero-interest loans for first-time home buyers. So, of course, all this economic program has a cost. At the moment, the Institut Montaigne is saying this would cost at least 100 billion euros extra for public finances, and this is why the bond market in France is so stressed at the moment.
Talk to me about what's happening in the polls, Caroline. If you put the rally, the RN together with the Republicans, how big a force would that be? And what are the polls telling us about kind of whether that would be enough to form a government and kind of what the makeup of that government would look like? What are the polls telling us about what is happening on both the right and the left?
Yes, so you have to understand that the French legislative elections are a two-round system. So even if you see that the first round, Marine Le Pen's party would get 35%, that doesn't necessarily translate into the second round polls. So the situation here is really a case-by-case basis. There is going to be a lot of horse trading between now and the first round, and between the first round and the second round in terms of who is supporting who. We heard from Jordan Bardella last night saying that at least a few dozens of Republicans would actually choose to support a national far-right candidate and not put forward their candidacy in those constituencies. Now, the head of the Republicans, Eric Ciotti, even extended ahead to Marine Le Pen saying, we're going to support you, something the Republicans, of course, never done before. That was totally out of the question. There is a crisis meeting this morning at the Republican Party to know the way forward. We'll hear from the president as well in a couple of hours from now, and a lot is expected from him to clarify the situation, to see what kind of alliances he could seek in order to potentially get even a fragile majority like he currently has. At the moment, the National Rally has 90 seats in the National Assembly. They are shy of 200 seats to win a majority, but anything is possible if they do some horse trading with the Republicans.
Caroline, thank you very much indeed. There's a lot going on in Paris this morning. We're going to be watching very carefully throughout the morning. We'll certainly bring you the comments coming out of the Macron press conference a little bit later on. 11 a.m. French time is when that is going to be taking place. Coming up, we need to talk about what's happening in private markets. Blue Owl Capital CEO says private credit is still a good place to invest. Before mixed messages out of super return, we are going to hear from Apollo's head of EMEA Global Wealth Management Solutions next. This is Bloomberg.
This is a really great time. And there have been some efforts by, I might call our antagonists, to paint the picture, picking little anecdotes here and there. But the reality is that we have not seen an uptick in defaults. We have not seen an uptick in companies having trouble performing. And I think that's by virtue of making really good credit selections and low loan-to-value investments.
But others might say that, unlike the public market, you don't have a Fitch or a Moody's saying that this is a default on the debt the way that they would for something that's traded on the public markets.
Well, a default would be a default in any market. You're right. We don't have the opinion of the credit lending agencies on the business. I would proffer that's one of the great advantages of our model for the user of capital. Listen, at the end of the day, as opposed to a third party, and no offense to Fitch or Moody's, they do a wonderful, wonderful job for what they're designed to do. But we're designed to provide long-term capital and make a very in-depth decision around those companies, counting on the long-term strategy to get paid back, and it works. We've done about $100 billion in loans, and our running loss rate has been 7 basis points. And so there's something quite substantial about the ability, like a long-term investor in equity, to take a long-term view of the credit, not what happened this week or this quarter, but are we going to get paid back? And the terrific news about our business is we consistently get paid back.
Seems like an important point. Blue Owl Capital co-founder and co-CEO Mark Lipschultz joining us there, talking about what's happening with the private credit environment. Let's delve further into that world. Véronique Fournier, head of EMEA Global Wealth Management Solutions, joining us from Apollo here in London. Nice to see you.
Good morning.
Thanks for stopping by to see us. Look, today's going to be about a bunch of things, but one of the big things that it's going to be about is the Fed and this higher for longer world that we're increasingly trying to get our arms around and understand. You spend your time talking to wealth managers, to clients. How are they thinking about how they adapt to this higher for longer world where rates are going to stay higher for longer and potentially never really come back down to where we were sort of pre-pandemic? How far through that journey of understanding the implications of that do you think we are? And how far into the private world has that kind of story, seeped?
Yeah, I think the search for yield continues to be a major theme for our investors and our clients. And certainly as I spend time talking to wealth clients, the yield enhancement focus continues to be a big theme. Fundamentally, people are recognizing that private credit can be a very attractive place for them to shift out of their traditional fixed income into more private fixed income. I think they're seeing, the yields are inherently higher today. I think there's a recognition that you've got to be careful around who you're going to partner with. And so I think partnering with firms that have established track records, that focus on downside protection. So we're certainly seeing a lot of still continued interest for direct lending and private credit in general. Across the continent and in the Middle East.
So you've got to select your manager quite carefully, is basically the message you're giving. There is huge amounts of uncertainty, though. We've got the Fed. You've got US politics coming up. You've got European politics that we're all trying to get our arms around, trying to understand what is happening in France right now. There is a huge amount of uncertainty. Yeah. Is that reflected in the conversations? And does that make your clients want to go towards or away from private credit? In a world of increasing uncertainty, is private credit a volatility dampener in portfolios? What role does it play, given the backdrop as well of higher rates?
Yeah, I think generally we're seeing that investors have felt the pain over the last couple of years of this changing environment that we're in, whether that's rates, but whether that's also geopolitics and just increased volatility. And I think investors have recognized that probably stepping away from some form of liquidity might enable them to access opportunities in private markets that can hopefully offer some more stability. And so generally, I think whether it's private credit or private equity or generally private assets, I think investors have recognized that stepping away, as I mentioned, from liquidity, stepping away from some of their public equity exposure to get more access to private market opportunities, diversifying their portfolio. The big theme is around diversification and recognizing, that a lot of opportunities sit in the private space. And why not, step away from liquidity?
Yeah, Veronique, you've said that a few times then, stepping away from liquidity, and that brings stability. Does that also increasingly, if that's the dynamic and we see it happen more and more in Europe, does that increasingly attract the eyes of regulators? Does regulatory scrutiny, if that's what they're doing, sort of stepping away from liquidity to find stability, does that attract the regulator?
I think actually the regulator in Europe has been quite supportive of the idea of private investors accessing opportunities that historically have only been available to institutional investors. And so I think we see the developments in Europe around structures like the LTIF. This is all about the regulator saying private clients should also have access to private capital. So, I think the scrutiny around liquidity certainly has to be there. The discipline, I think we have, been at the forefront of launching some of these more semi-liquid strategies and new structures and innovating in the space that requires discipline around, how you bring that liquidity. But I think actually the regulator is supportive.
And what's the lag between US adoption of something in this space and European adoption? Because you're growing in Europe, but it is, it is a place where maybe appetite for this kind of product has been a little behind the United States.
Yeah, I think it's been, I think we're super excited about the opportunity in Europe. When we look at when we did our analysis a couple of years ago, we actually estimate the market to be a 15 trillion market. So that's in terms of the wealth from EMEA clients. So we're super excited about the opportunity in Europe. But you're right. I think the lag comes more around the availability of structures. When you think about BDC, private BDCs, they've been around for 15 or so years in the US. In Europe, we've only had the LTIF launched maybe 5-6 years ago. And so it's just been a question of the structures and providing the access has really been more limiting in Europe. And there's been a massive shift within that. And so we now think that this is really a prime time in Europe.
Is it that those conversations with the potential clients in Europe, is that a key question for them, the relative illiquidity of some of these products and how you address that?
Yeah, I think many investors are now excited about the ability to come to private markets because these new structures allow them to do so.
And that continues to evolve.
And that continues to evolve. Historically, investors have had access to locked-up structures with capital calls, and those have been operationally challenging for investors, whether they come through direct or whether they come through an intermediary. The fact that they're now able to trade on a monthly basis into a private markets fund has really kind of helped facilitate the access, and we see that as a big theme generally.
Give us a sense, give us some colour on the potential deal making for Apollo. There was that flagship deal with Intel in Ireland, $11 billion US. Apollo have talked about the fact that there are other deals in Europe that could be looked at. What is a good fit for Apollo within that space? Which sectors are looking most attractive? Where are you looking to put some of that dry powder to use?
I think it's all about being really a strategic partner to some of the large, sophisticated companies out there that are really looking to finance, their big strategic goals, whether that's around infrastructure, energy transition, the technology of tomorrow. So I think those would be kind of areas generally that we'll be looking to be a strategic partner to some of those corporate companies. Yeah.
Can you talk to me about regulation across Europe? We've been having a lot of conversations about the need for Europe to get its act together and form a more coherent picture for investors. We've got this patchwork across Europe in terms of the various regulators. Is that going to hold Europe back? Is that holding back Europe? You talked about the fact that we are 10, 15 years behind where the US is right now. Is that spread going to continue to grow between what is happening in the United States and what's happening here in Europe because we don't have a common approach to regulation?
I think that common approach to regulation is coming. I mentioned the LTIF already. Yeah. I think the recognition, I think the European regulators have recognized that they need that consistency in order to have the mass facilitation. So I think we're making progress in that direction. And I think there will be a world where we are, all using kind of the same structures across the EU. But we're starting from a base where maybe different regulators have taken a different view in terms of how illiquid assets should be getting into retail investors' portfolios. Yep. And some have taken a very open view to that in some countries, and some have taken a more restricted view. But I think there is a common acceptance now that that journey needs to be enhanced, and we think that the LTIF will be a big part of that.
Do you think regulators are going to wait till we've been through a full cycle? Private equity, private credit, private lending has been around for quite a long time, but it has gained significantly over the last few years in terms of the impact that it's having. Do you think we need to see, do you think clients, do you think regulators, do you think the people you're talking to are waiting to see kind of the whole cycle emerge, an up cycle, a down cycle, before they get a true understanding of the opportunity that exists and the potential within portfolios that this space could have?
I mean, I don't see the investors sort of waiting and sitting by the sideline and kind of expecting this market cycle, as you mentioned. What I do see is them being very excited about the opportunity to access asset classes that just hasn't been available to them. And there's been really at the foray only of institutional investors. And, I think that's, I see a huge continued demand. Yeah.
Veronique, nice to see you. Thanks for stopping by to see us here in London. Veronique Fournier, Head EMEA Global Wealth Management Solutions, joining us from Apollo. OK, what have we got coming up for you? A double whammy. Traders very much on edge at the moment. We are waiting for the US inflation data. We're waiting for that Fed decision. Anna says it's, 5.5 hours later? So we're going to pay attention to that gap, see what happens in the meantime. We're going to break it all down. We're going to talk about this next. This is Bloomberg.
New Democracy did win the election with 28%, and that percentage is higher than the total tally of the second and the third party. So we still remain the dominant political force in Greece. So one should take into consideration the fact that these elections took place a year after a double national election, so there was significant electoral fatigue. We actually had a significantly lower turnout than the rest of the European Union, at around 40%. But I'm sure there was also, some degree of discontent with issues such as the cost of living, which we need to address. We've been elected to implement an aggressive reform program for the remaining 3 years of our term. And this is what we should do. We now have 3 years without any other elections. And we will be judged again on our performance in 2027. But I think we sort of went against a trend where, incumbents in many other important European countries actually suffered heavy losses. We avoided that, and we're still the dominant political force in Greece.
Well, indeed, and we look to France, of course, for the reaction there. Marine Le Pen and the risks there, and the decision by the French president to call that surprise parliamentary vote, and of course the gains of the AfD in Germany as well. What do you make? What is your interpretation of the shift to some of those right-wing parties across the Eurozone, whether it's a protest vote or there is something more substantial going on here?
Well, first of all, if you look at the total numbers, the EPP, the main centre-right European party, actually increased its numbers of Euro MPs. And the main sort of coalition between the EPP, the Socialists and the Liberals that has essentially governed Europe over the past decades remains the dominant coalition in the European Parliament. So I would argue that the European centre held, maybe stronger than many people expected, and that this right-wing surge did actually take place in the two most important countries in Europe, but not across the entire continent. So I think there is maybe some degree of over-exaggeration about this right-wing shift of the European sort of continent as a whole. If you look at the numbers in the European Parliament, I think the important decisions will continue to be made by the three political families. And of course, nothing, I need to point out, nothing can happen without the EPP, which essentially has sort of a blocking minority now in the European Parliament. So I think all in all, the results were probably slightly better than many people expected, and I do think that there is a momentum to drive through important changes in Europe for the next 5 years.
That, of course, was the Greek Prime Minister speaking to me exclusively earlier today, saying don't overplay this risk, or at least the focus on the right-wing shift, reminding us that the EPP, of course, those centre-right groupings within the European Parliament remain dominant. He remains dominant. His party, New Democracy in Greece, which is within that centre-right grouping as well. There was a right-wing shift in Greece as well. Collectively, groups, a number of parties, there's about three parties that fall into that category, got about 18% of the vote. But look, Guy, as you were saying earlier, it's pretty fascinating to posit that Greece is now a beacon of stability within the Eurozone versus France and arguably Germany as well.
Germany is still... I think politically, Germany has obviously got a lot of questions that it still needs to answer. And this coalition is clearly very, very fragile. But you are seeing an effect of France into the periphery. And I think it'll be interesting to see how far that takes us. If you were to see a win for the right in France, how wide do OATs get versus Bunds? How does that force BTPs wider? Does that start to cause maybe some dominoes to fall? I think that the market just doesn't know at the moment. Nobody really has got a handle on what is happening here. Yeah. The politics are a bit of a shock. And the markets, I think, are kind of in uncertainty mode.
And you were asking our guest from Natixis earlier that very question about, how wide does the spread get if we do see a change in Parliament? And the view from Natixis was that we're not talking about a base case where you've got to price in Frexit. That's not what we're talking about here. But we are talking about real uncertainty on the fiscal front, and that really seems to be the question that the markets want clarity over. And what's interesting is we're going to hear from Emmanuel Macron, the president, later on. It's not up to him to give that clarity right now, because, of course, if he says he's staying in power, that's one thing. But if the makeup of the Parliament changes, then we'll want to hear from the National Rally. We'll want to hear from them what their plans would be if they put the Prime Minister in place.
Yeah, and you've underscored that there's the importance of listening to what they detail on their plans. And Caroline was outlining this is not a traditional right-wing party in terms of its fiscal priorities. This is a populist party, so nationalising the roads, for example, reducing the retirement age to 60 with the huge hit to the finances that would... Are they sticking to those kind of pledges, or will they moderate, if you suggested, would they, caveat, of course, to the kind of Maloney type?
Who would the finance minister be?
Yeah. It's OK, you've got a 28-year-old Prime Minister.
Yeah, precisely. We're only... there are articles that are being well read on the Bloomberg and elsewhere about who this guy is. Yeah. We're trying to get our arms around who Bordella is. Who would be the finance minister? My understanding is, and we talked to a lot of French CEOs, nobody knows yet. No, everybody's trying to answer that question. Who would be the finance minister of this new government? What type of finance minister would they be looking for? What are the kind of expectations of that? Nobody knows.
Yeah, these will be the key questions then. Let's get a markets perspective from the Markets Live team. Bloomberg strategist Ben Ram joins us. Ben, help us understand what it is that the market is going to be watching for, because we will hear from Emmanuel Macron, the French president, today. But really, the market is very keen to hear from the National Rally and what their plans would be if they were to be successful in July.
Absolutely, Anna. If the National Rally were to be successful in July and they're going to follow populist policies, that is going to imperil France's fiscal deficit. It's already at 5% of GDP. That reads more like an emerging market fiscal deficit rather than a budget deficit of an economy as advanced as France's. So if it worsens the fiscal deficit, I think that the markets will be right in the fears, and which is why we have seen the French yields spiral. And I think that continued pressure is going to be present on French securities. I think that traders, as far as the traders are concerned, they're going to be selling the securities first and asking questions later. As you were just talking on the show, there are plenty of questions about who the next finance minister will be, whatever the implications. So the traders are not going to wait around to see the implications. They're going to first hit the sell button before talking.
OK. Ben, what does this mean for BTPs? What does it mean for Spanish bonds? What does it mean for Portuguese bonds? What does it mean for what we used to describe as peripheral Europe?
Absolutely. I mean, it's a bit of an irony that the rest of peripheral Europe is doing better than, the core economies. As I wrote this morning, if it rains in Champs-Élysées, it's likely that the umbrellas will go up elsewhere in the region as well. And that's the collateral damage that we are seeing at the moment, because investors are thinking, well, if this is what populism means in Europe, what does it mean for Italy? What does it mean for Greece? At the moment, it's contained, but there will be some repercussions, meaning that yield spreads will widen that much more in Italy and Greece, albeit not to the extent that you would see in a typical distress, but a bit of widening is par for the course from here.
OK, Ben Ram. Look, we don't have any certainty on the political front out of Europe. Thank goodness we have certainty when it comes to the Fed. Question mark. Ven actually saying from MLive, thank you, Ven, that there's a view that he thinks the Fed should actually, in terms of the dot plot, should go to zero for this year. That's fair.
The market's at 1. Yeah. So in order to be hawkish, do you have to go to 0?
Is that what's needed from this Fed to convince the markets?
Is policy restrictive at the moment? Does it feel restrictive? Now you're seeing a very gradual slowdown in terms of the data, and there is this concern that you see a re-acceleration. In order to be how do you communicate restrictiveness and the fact that we are going to maintain our restrictiveness? Is it you just take it to 0? And that would be beyond where the market currently is priced.
That would have been an incredible hill that we've walked up and down again, wouldn't it, over the course of 2024, if that were to be the case. We're kind of in the middle of the year, and we got so overexcited in December at the prospect of rate cuts. 7, exactly, that kind of festive gift that we got from Jerome Powell. And we've spent all the year so far, year to date, it's just been an exercise in walking that back. And yeah, where does the Fed leave us then at this June check-in on the dots?
And yet equity markets have continued to rally.
Yeah, well, that was the point that we heard from Norman earlier. You asked, how vulnerable are stocks to if we get the Fed saying we'll only get 1 cut, maybe 2 cuts, or even 0 cuts this year? How vulnerable? He didn't seem too moved. He went very quickly to a conversation about earnings. He said it's all really about the earnings story. That's what we're waiting for.
Yeah, I wonder if these tariffs from Europe on EVs is going to affect the earnings stories for German and French automakers. This is a story that lines cross, and we haven't had it confirmed yet.
Yeah.
But in terms, we've been waiting for these tariffs to be announced from the European Union, and EU is to notify China on EV tariffs today. That's according to officials. Tariffs may be around 25%, not confirmed yet, but maybe around 25%, not insubstantial or unsubstantial then. China earlier saying that EV tariffs would undermine Europe's own interests.
OK, let's just talk about that for a moment.
Yeah.
So, in some ways, you could argue this is good for European car makers because they will be protected from Chinese EVs, but you could also argue it is absolutely shockingly bad because the big luxury brands in particular rely heavily on China in terms of their profitability. Now, that's been under pressure recently as the local brands have come through so strongly, but this is the double-edged sword.
Yes, and markets seem confused about all of that, because even before we got this news around where the tariff was going to be, I mean, maybe the market had made assumptions about what it would be already, because we knew it was coming this week. Even before we got that news, the sector was selling off this morning. It was underperforming. It kind of bounced back a little bit ahead of the news flow. Now it's selling off a little this morning. There does seem to be a lacklustre appetite for autos this morning.
Olaf Scholz has been pretty firmly against this over in Germany. I bring it back to the French politics. If you had to have a Marine Le Pen or her party in power, to what extent would they double down on this kind of push for further tariffs?
Well, if you take the Trump playbook, he was aggressively against China, aggressively for tariffs. That was the narrative that came from there. Is that something that will be replicated here in Europe on a more assertive basis?
And how much does, if we did see a far-right party having more control, exerting more control in France, how much does that question lots of things we've assumed about the EU going on from here? And that's what this year is about, really, isn't it? It's about loads of people going to the ballot box and getting another assessment of support for some of these European policies or not.
3 big volatility events today. Let's talk about them. You've got the Emmanuel Macron press conference. That's going to be taking place at 11 o'clock. Look forward to that one a little bit later on. Then we're going to get into Fed territory. Get CPI first, 8:30 Eastern. 2 o'clock is the Fed decision. The surveillance team is going to be bringing you special coverage of that Fed rate decision a little later on today. It's all going to kind of kick off at around 6:30 p.m. London time. I will be up. I will be tuning in. You should be as well. It's obviously late in the day when you start this early, but we've got a stellar cast coming up to join the team for all that data and the Fed decision. Former St. Louis Fed President Jim Bullard's going to be joining us. Mohammed, of course, is going to be on the team as well. Mohammed Al-Arian is going to be giving his view. Bank of America's head of US economics, Michael Gapin, is going to be joining Bloomberg as well. We've got an exclusive conversation coming up a little bit later on as well with the legendary short seller, Jim Chanos. That is a conversation you are going to want to tune into. It's a big day. It's going to be a volatile day. There's some major events that you're going to want to watch out for. Bloomberg has got it all covered. We're going to continue the conversation next. Francie Lacroix is going to be picking up the baton. The Pulse is next. This is Bloomberg.